Good morning, everyone. Welcome to BodhiBrew, offering advantage through insight. I'm your host, Confidi Kong, Creative Director of Bodhi Research Group. In today's episode, we cover stress testing with Senior Risk Manager of RBC Global Asset Management, Dr. Phillip Ashby, and our visiting researcher, Dr. Niall Whelan. We both discuss the methodologies and purpose of stress testing. Dr. Phillip Ashby has specialized in quantitative risk management since 2015. Prior to joining RBC, he held the significant positions at Scotiabank, serving as a director of capital market stress testing and senior management of quantitative analytics and methodology. So sit back, relax, and enjoy a cup of brew with us.
Hello, and welcome to BodhiBrew. Today, I am going to be talking with my good friend and colleague, Phil Ashby. We worked together for many years at a previous financial institution, and our topic today is stress testing. Stress testing is very topical because there are always stress events coming our way. Obviously, we all lived through COVID quite recently, which came completely out of the blue, and there's no end of geopolitical events, boats getting stuck in canals, bridges falling down, other things that end up having effects on portfolios. So today we're going to be talking about stress testing and how you do it, what the purpose of it is, and so on. This is a topic that's near and dear to Bodhi's heart. We've done a number of projects in which stress testing was very prominent, including talking about tail hedging with pension plans and putting together risk frameworks for funds for which stress testing is a very important part of their risk framework. So this is, as I say, a really good topic, and Phil is as expert as anyone I know in it. So we're going to have a great conversation. So Phil, let's kick off by just asking a really simple-minded question.
Sure.
What is stress testing?
Stress testing is when you subject your portfolio to some sort of adverse shock. It comes in a variety of forms. Maybe the simplest form is what we call sensitivity analysis. So you might want to understand, what is the sensitivity of my portfolio to an extreme interest rate move, or whatever your risk factor of choice is. And so you typically pick a range that's really big for that factor to move. Maybe interest rates up 200 basis points, maybe 100 basis points is big enough to be considered a stress scenario. And you see what the impact is on your portfolio's loss, typically. Stress tests also come in more complicated forms, though. So that sensitivity analysis is the most basic form. The more complicated forms are when you want to shock all the factors at once. And the obvious question is, how do I do that in a way that is coherent? So the most obvious way is to do a historical simulation. To say, okay, let's play back the events of, say, 2008 or the dot-com bubble, whatever your favorite stress event is. COVID, yes, exactly. If you want a very short-lived bizarre shock, COVID is a great example. And run your portfolio through that period again and see what happens. That's a really great exercise to do because it appeals to our past experiences. We lived through those events. We understand what it means for our portfolios to go through those on some sort of base level. Even if the events of the future aren't going to repeat exactly how they did back then,
Sure.
They might rhyme a little, right?
Right.
And the third kind of stress test are these they're more art than science, where you really sit down with a bunch of experts, maybe the PMs, the risk team, economics, basically everyone who has a say in this, and you try and figure out, what shocks should we be worried about? What's coming up in the future? So you never know, is the market going to go up? Is it going to go sideways? Is it going to go down?
Right.
But you want to ensure that your portfolio is going to do okay in all of those environments. And so it's a big exercise to undertake to understand that.
Interesting. Now, you have experience both in buy side and sell side.
Yeah.
You're working at a large Canadian bank, and working at an asset management firm. How do they think about it? Like, what's the same and what's different for those types of firms?
Right. That's a good question. So we can start with the general differences in how the models are constructed, because that informs how we do stress testing.
Sure.
And the biggest difference is, and it's a really simple difference, is that on the buy side, your risk is measured relative to a benchmark. And it sounds like a really simple difference. Okay, I just want to see how I'm comparing to the market and say, okay, I'm doing 2% better than the market, yay, or I'm doing 2% worse, boo. But it actually has a huge impact on how you measure risk. So on the sell side, if the whole market crashes down, that can blow your portfolio up. And on the sell side, as long as you're still outperforming, even in a downturn, you're still delivering excess value to what could be passive investors.
So does that mean that you are stress testing your benchmark as well as your own portfolio when you're doing that?
Exactly.
Okay.
And so how one does that, it's a bit of an art, because if you do that poorly, you could imagine you get no impact, right? If I just move the whole market down. So you have to do things in a way that actually reveals how one is going to do in those adverse events.
And sort of the basis between your benchmark and your own portfolio.
Exactly. So that is a subtle but very big difference in how one measures performance. A second big difference is leverage. So there is no leverage almost on the buy side. There are some funds have leverage, but if I just hold a long only portfolio of equities, I'm of course completely unleveraged. So wherever the market moves, I go with it. I'm also holding those, I'm planning to hold those equities for a much longer period of time. I might want to hold them for 1 year, 3 years, 5 years. If I'm a pension fund, maybe I want to hold for 30 years and I have some infrastructure sitting on my balance sheet. So those are other huge differences between buy and sell side.
Okay, well, that actually maybe gets into a little bit about scenario design then, because if these different types of firms are looking at their risk profile over much different time horizons, I think that's true. So how do you think about scenario design and how you actually create those scenarios for the different types of firms?
So our sort of key model as risk managers are factor models. The factor models are not unfamiliar, but factor models allow us to have a sort of segregation of responsibilities. So you have a piece that is alpha. That's what the investment team is trying to work on. So they're trying to deliver value by looking at the companies, again, doing their own scenario analysis to say, okay, if I'm in a bear market or a bull market, I still want to pick companies who are going to deliver value. Maybe you're going to deliver less value in some of those scenarios. But they can really focus on the alpha piece. And then risk management can focus on the betas. So all the factors in the model and say, okay, we have all of these sensitivities to all of these different factors. How are they contributing to your performance? And how are they contributing to your risk? So what we do is we really design scenarios in the language of the factor space, if you want to think of it like that. And that lets you speak about both about the benchmark and about your portfolio in a meaningful way.
So what would be an example of a factor?
Those are good questions. So simple things like country and industry could be factors. There are also more generic, they call them style factors, which are things like growth or value or size, momentum exactly. So, you can design. Portfolio engineering is a big thing. Feature construction is a big thing, but maybe you want to have 10 or 15 of these things. Actually, if you look at the distribution, like if you just take the empirical covariance matrix, you end up with something that looks like a white noise distribution plus some outliers. And those outliers are in the tens, maybe between 10 to 30. So that tells you need maybe 30 factors to describe something like the S&P 500, and then the rest is just coming along for the ride as white noise. Now, what those factors are, I'm talking statistically here. What those factors are, they might be changing over time. They are some horrible combination of the industries and momentum and all of this stuff, right? But you don't need so much.
Okay. Well, 30 doesn't sound like...
30 is not small or big, right?
Yeah, exactly. But the factors I'm going to be looking at presumably are going to depend on my own fund and its own idiosyncratic properties, or are these going to be universal?
So vendors will try and sell you a model that has as many factors as possible because they want to cover all their bases.
Yes.
If you're doing more quantitative work for a specific fund, my suggestion is to really try and engineer that to that fund as much as possible, understand their investment process, understand what they are thinking about the markets, and try and build those custom models so that it can you can relate to them when you go back to explain performance or explain where risk is coming from. Then you're really speaking their language.
Okay. And this perspective then works because I think most of your examples have really been about equity and funds that are invested in equities. But if I have a fund that's, for example, commodity based or trading in
Or
credit,
fixed income.
yeah,
Yeah.
how am I thinking about and designing my scenarios for that?
It's again factor models.
Yeah.
There, the factor models are going to be different. They're going to be factors on the yield curve, for example, if it's say a fixed income fund. So they're the oscillations of the yield curve and the
parallel shifts and twists.
Exactly.
And, okay.
So you have maybe 3 factors there: parallel, this whatever that is, and then
right. Okay. And once you have your scenarios and you run it against your portfolio and you run it against your benchmark and you get a bunch of results, what are you doing with these numbers? Like, how does the firm actually internalize and make use of these results?
Good question. So one is for planning. So you want to, again, understand from sort of a fundamental view, how does my portfolio look under a variety of outcomes?
Right.
So you can run adverse stress tests or you can run recovery stress tests, and then you can see, okay, how is my performance doing? So that's maybe the most obvious thing to look at. Do I lose or gain? The second thing is risk. So risk has to do, and maybe it's not a good definition of risk, but it's one we have, with the variance of the returns. And again, that variance is measured relative to benchmark. They call this tracking error. So how does the composition of your tracking error change under these different scenarios? So what you can do is you can break down the tracking error and you can say, this much is due to factors, this much is stock specific. You can do the same thing for performance. And looking at how that changes really enables you to view the landscape of risk. So you can imagine painting this landscape, whatever. If I look at the quantile of my loss, so maybe I start from the median and I go all the way out to 100%.
Like that's the worst loss you could ever experience.
So I run I fit some covariance matrix in my factor space, and then I simulate a bunch of things. So in that tail is where my stress tests live.
Right.
And maybe I run a few of those every day or every month for standard reporting. But there is really a landscape as you sweep out, and it's a bit bumpy if you look at it.
Right.
And then it also has a dimension along time. So you might have your 1-day stress tests, your 3-month, your 1 year. And what you want to do is sort of print that out for funds that you're looking at and then understand, okay, over here, I have these factors driving the risk. Over here, it's all idiosyncratic. Over here, these factors are poking out.
I see.
And then you can engage, again, with the investment teams because you don't want unintended bets. If you're not planning to bet on a factor and then it starts rearing its head somewhere, that's where you want to have that conversation and understand how you can, do we need to change the portfolio? What's going on there?
And how do those conversations go? Like if you actually take your results to a portfolio manager and say, oh, you've got an unintended factor that you probably don't mean to be making a bet on in your language.
In my experience, they've all gone pretty well. And maybe that's because I haven't presented anything too surprising. Like I say, oh no, we do know about that bet.
Right.
Like, it looks like this thing is happening in that stress test and we are aware of that. And here's our plans to manage it. And so I guess I don't have any super exciting stories where something's poked out and it's like, oh no.
And when I think about use of stress test results, I guess I'm also thinking as a measure of risk appetite. And is that something that you typically see being used, that stress test is used as part of a risk appetite framework?
Yeah, so that's used a bit differently on the buy and sell side. So on the sell side, you're used to using that as sort of a floor on how big your losses could get. So you say, I don't want to lose more than X dollars. And if one of your stress tests trips that, you're going to be worried. Here, we're worried more about risk concentration.
Okay.
So if in your performance allocation or your risk allocation, again, these factors start peeping out where they shouldn't, that's more where we become worried from a risk monitoring point of view.
Right. Yeah, I guess on the sell side, there's a whole layer of capital and calculating your capital and tracking that and the stress testing, the backstop for that, which I guess not really relevant on the...
Yeah, we just want to make sure we're delivering the value to our clients and that there's nothing going awry there.
Right, right. And in terms of one thing I've always liked about stress testing, and you sort of touched on this earlier, is because it's so narrative driven, it makes it easier to explain. Like if I've got some complex market risk model with lots of simulations and percentiles, and it can be very difficult to actually make that real for people. Whereas I find stress testing and scenarios is a little bit more story based and therefore more understandable. I don't know if that's something that resonates with you, or do you find?
Yeah, I find that that's definitely true. I mean, the natural language of humans seems to be communicating through stories.
Yeah.
And maybe people are even collections of stories. So again, even if you want to explain something from a complicated risk model that has all this very, nice mathematics or whatever behind it, pulling out the story using a specific scenario and saying, that's how I'm going to frame this number,
Right.
can really help people to understand. It's like, oh, okay, that's like this experience that we had in 2001, but with a little twist on it. And then, it allows us to draw back on those memories, put it in perspective, and go from there.
All right. So I'm going to switch gears a little bit, sort of maybe figuratively and literally. Reverse stress testing. That's a practice that I know you're quite passionate about. We worked on that together. In fact, you and I. Could you just tell us what reverse stress testing is and why it's useful?
Yeah. So reverse stress testing is when you flip the question of stress testing on its head. So stress testing, as we've described it, you take a scenario, you produce some results, and then you're done.
Right.
So now we want to say, what if I lost 5%, 10% of my fund's value? How do I get there in the most likely way possible? So there's a bunch of ways in which I might be able to lose that much, but I want to know from where I'm starting today, how do I get to that loss the easiest? And this quickly becomes a really hard question to answer, because what does that mean, the most likely way?
And why do I even care about that question?
You care about that question because maybe it's super likely that you'll lose 10% and you don't know, because you've designed your stress test. Again, I said stress testing is more of an art. So your stress testing design, you might have all of these different scenarios, but there might be a blind spot that you have. And reverse stress testing can help fill in that blind spot. So it could pull out some bizarre combination of factor moves that maybe you didn't engineer,
Right.
not for a lack of trying, but just some lack of imagination, I guess.
It's never occurred to you.
Yes, exactly. And all the financial crises we've seen are highly idiosyncratic, right?
Yes,
So we
that's
only
true.
have so much experience to draw on.
Right.
So reverse stress testing is hoping to fill in that gap. The approach I like is inspired by sort of statistical physics and information theory.
Because you're a physicist.
Because I'm a physicist by training. So I have a lot of bias there, where I really want to take the portfolio and really push it towards that most likely way that I can lose $100 million or whatever the number I'm trying to aim for is. Now, there are other ways to do it if you don't have some sort of sophisticated probability model where you can play these tricks. You can just start with your suite of stress tests and try and cluster them, look for common features, and then drill into it this way.
And one of the things I like about stress testing also is when you think about your example of how likely am I to lose $100 million, and you somehow figure out what is the most likely way you're going to lose $100 million. While that is the most likely way, it still might be, it's more likely than any of the other ways you could lose $100 million. It still might be fantastically improbable. And so that gives you some sort of comfort too, right?
Yeah. Well, and what's cool about this is once you tie things to a likelihood, you can put your current stress tests on that sort of likelihood scale.
Right.
And you can say, oh yeah, this one is way less likely than how the market changed in 2008. And that lets you put it in perspective once you have this measure of likelihood, because then you see, okay, this is what the market looks like in normal times. Here's what the likelihood of all of these historical events looked like. And it gives you sort of a calibration knob for how you design your stress tests, which I really like that.
Yes. Yeah. And it's, I mean, just for people with a more quantitative background, it's sort of a fun problem to try to find that scenario.
Yeah. And there's no right way to do it.
No.
It's definitely an area where there's a lot of open research and people are working hard to try and, fit the tails of their portfolios to really understand the tail risk that's there. So,
but you can get at it. You don't necessarily need to have a complex quantitative approach, you can also get at it from more qualitative considerations too.
Yeah, absolutely. Yeah. And that's the way to start, right?
Mm-hmm.
So
I am going to switch gears one last time just to wrap this up. Another topic that you and I spent time working on together was climate risk and using scenarios to try to help banks assess their climate risk. So how do you think about stress testing, and maybe it's better to say scenario analysis as applies to that problem?
Yeah, so scenario analysis is definitely the language for climate risk modeling as it applies to financial institutions, because the way that those things work is climate scientists and economists, these big teams of international teams, hundreds of people working on this, have come up with many different possible ways that we can shift to a low carbon future, and even some ways that we will not shift to a low carbon future, to sort of, again, have a benchmark. And they've presented these to the financial institutions in a sort of compact form, showing how the economy will change from today to these various future states. And those scenarios are massively long in time horizon. They go out to 2080, 2100. So if you think forecasting a year or 2 years is hard, right? Like 80 years is absolutely difficult. But what these scenarios miss is they only sort of describe the smooth evolution of the economy from now into the future. And so stress testing is going to come in as a layer on top of that. So even in the best, most favorable climate scenario where we take immediate action, everyone works together, there's still going to be market dislocations that are going to happen. And stress testing is going to help answer some of those questions. So if we make a rapid push for decarbonization, that's obviously going to disrupt markets, and prices are going to shift wildly. Liquidity will dry up in certain sectors, all this sorts of stuff.
Firms will have stranded assets.
Exactly. So the value wasn't what you thought it was, right?
And I guess if you're a bank, it means the collateral underpinning a loan isn't
exactly
what you thought it was.
So that changes the landscape potentially very rapidly, right? And that's really the language of stress testing.
Right.
So I think right now financial institutions are getting used to implementing these big long-term time horizon models from the climate scientists, which is a great first step, sort of the zeroth order of how we're going to get to net zero. But then we need to build in these disruptions on top of that to understand, okay, what are the challenges we're going to have along the ride?
So as a division of labor, the climate scientists, the economists are sort of coming up with these scenarios, but what that means for a particular financial institution would be...
You're going to have to look at your portfolio.
Right.
You're going to have to talk to the people who invest and see, okay, what are you worried about if the economy follows this trajectory? Like, how do we need to rethink things? And that work is happening. So,
well, listen, I think that's about all the time we have for today to talk about this. This is such a great topic, and there's so many threads to it. We really only touched the surface of some of these, but still, it was a good primer. So thank you very much, Phil, for coming in and talking to us about this.
Yeah, thanks for having me. It's been a great talk.
Yeah, you too.